do as well. So it's interesting. We've been table pounding on tech throughout the last couple of years, but as we rolled into this year, we didn't say short them. We said basically go to neutral, because as long as the cycle continues to be inflationary, they just struggle a little bit more. And what we actually see, and we've done a whole bunch of quant work around this, is that when inflation is high and stubbornly high, you actually want to be in stuff that's more cyclical, beneficiaries of this. So energy stocks, material stocks, and the like. Not because these are the best stocks forever, but they're the best stocks for the moment.
Will those tech stocks continue to have revenue growth?
Yeah, but if you take a look, like in the last, let's say the most recent earnings season, tech names, grew about 7%, but those cyclical groups grew something like 30 or 40% because they just did better. They have more operating leverage, more physical infrastructure in the kind of old economy cyclicals, and therefore they have more upside. And if you look at this earnings season, those tech companies were, the mega cap tech companies were pretty lackluster. So it's not just a sentiment issue. They're having a harder time, but also they went into the year very expensive. That run that we were predicting in tech played out beautifully, and sometimes you have to know when it's time to take your foot off the pedal, which is what we did on tech earlier this year.
How do retail earnings fit into your thesis?
Well, Lisa, I think that everybody, starting really last Friday, thought that the worst was behind us. And then with, Walmart and Target news, people felt like they got kicked in the stomach, that maybe the consumer's rolling over and companies are going to have margin problems. And then if you actually look, we had a lot of companies like, TJ Maxx and Home Depot and Lowe's, and they did fine. They had beats in the high single digits. It was really a couple of these prominent names like Home Depot and Lowe's had a harder time. And a lot of those were really what I would call is a mix issue. People were buying groceries, but they didn't want to buy furniture and TV sets. And in many cases, these were really merchandising problems. They were kind of the wrong products as people are rotating towards experiences in restaurants and hotels and getting back out. So I'm not sure that we should be over extrapolating some of the bad news from those retailers, but I will tell you, it surely shook the market in the middle part of this week.
So that's the glass half full view of these retail earnings, that basically it is a mix issue, not a consumer health issue. And some people would agree with you, Jonathan, but doesn't that give you a sense that the Fed is going to raise rates all the more so to try to stave off some of the inflationary pressure, because the consumer still has momentum, and that presents a valuation problem for stocks, as we were hearing from Savita Subramanian of Bank of America earlier this morning?
Yeah, I'm not sure that the Fed responds to the retail earnings, but
generally the trend.
But listen, wage inflation is really high. When a year ago, when we had 3% inflation, people were saying that's peaking. There's no way it could get to 4%, and now we're over 8%. So the Fed, I don't want to say they're on autopilot for a little while, but they're going to have to push rates, at least to 3%, which is what the market's discounting. And my view is by the end of next year, we may be closer to 4% on Fed funds if they need to, really,
But hold on a second, Jonathan. In all honesty, then, how can stocks keep rallying? How can you get to near 5,000 by the end of the year on the S&P if you get a 3 or 4% Fed funds rate?
Well, the most important thing is corporate profits are holding up really well. And so take a look at this earnings season. Revenues are running on the S&P 14% this quarter. Earnings are up 12%, so the margin pressure is tiny. But we had this really weird thing going on with the banks, with reserve releases. And if you took that out, the revenues were 15% and the EPS was 20%. So the earnings are super powerful and stocks are cheap at this point.
John, that is the most intelligent thing I've heard this week on equity optimism. That differential equation is linked at the hip with nominal GDP and the decline. Are you suggesting, within all the Credit Suisse work, that the great miss here is that nominal GDP will sustain longer, which will allow companies to adapt into the gloom Lisa just mentioned?
Tom, I think that is the only story. I mean, my favorite, the one screen that I look at the most on my Bloomberg terminal is ECFC. Where is the consensus view on what the economy is going to do over the next quarter and year and 2 years? And what it tells you is that nominal GDP this year should run at 9%. I mean, normal is 3.5%. For all of those folks who say, oh, we're going into recession, economists all over are basically saying this is a rip-roaring economy.
You know, I'm going to tear up here, John. John Golub has really drunk the Kool-Aid at Credit Suisse, Donaldson, Lufkin, Genret. He's on the edge of Tom Galvin here with a sales-centric view.
I'm going to try and be polite here. ECFC, okay. John, has that ever been a leading indicator for anything?
Well, I mean, you know, Jonathan, you have to use some framework to say directionally, where do we think that the economy is going? So if you're looking at, you know, where inflation is going, you can look at the TIPS market. If you're looking where GDP is, there's no tradable instrument on your Bloomberg. You have no choice but to use either your own house economists, and our economists guys are also pretty bullish, or you could just say, where's the whole gang thinking that the growth is going to be, and that's what you find on the terminal. And not only can you do it, but I can see it by firm. So I can say, what are the biggest shops? What do the people at the Fed think it's going to be? They're all in the same direction, which is the underlying economic growth measured in nominal dollars, that's including inflation, is going to be really strong this year. And here's the most important thing, and really strong next year as well. That's not Golub's view. That's
no, I hear all that. I hear all that. It's just the Fed forecast. John, when did the Fed ever forecast a recession? I mean, it's just not. Well, it's not in their business, is it?
They do it about a year with a year delay. You know, they do it after the fact. But listen, I get that, but you have to use some framework saying, where do you think the world is going? If you ask me what the most important issue is on inflation and growth, we have an incredibly tight labor market, which is leaving the consumer really confident in their ability to find work, and that leads people to be willing to go out and overextend themselves on credit. And it also means that you have high wage inflation. You add those two things together, it's all about the labor market. And that's my take, independent of what you have on that forecasting screen.
A defiant bull. John is going to catch up, buddy. As always, Jonathan Golub there of Credit Suisse. Bramo, I will give John this. That retail story this week, far more nuanced than first look.
Absolutely, especially because of Home Depot, and to a lesser extent Lowe's, as he was saying. That said, there clearly is a margin issue that we have to get our hands around and understand.
I like the ECFC function. It's not, you know, I've not got a problem with the function, just I'm not sure what it forecasts and how accurate that's been over the years. Futures on the S&P up a little more than 1%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. President Biden arrived in South Korea and immediately underscored the importance of resolving the global semiconductor shortage. The president toured a Samsung chip factory that is the model for one the company plans to build in Texas. The White House says the Texas plant will mean good paying jobs and more resilience in the supply chain. Meanwhile, Bloomberg's learned that President Biden is considering a meeting with Saudi Arabia's Mohammed bin Salman as soon as next month. That would mark a shift for the president. He has avoided contact with the Crown Prince over the murder of journalist Jamal Khashoggi. PIMCO and BlackRock are amongst the firms set to start debt talks with Sri Lanka soon. Bloomberg's learned that Alliance, Bernstein, T. Rowe Price and Wellington are also amongst the members of a creditors group. Sri Lanka fell into default this week for the first time in its history. An economic meltdown has led to protests and a political crisis. And the largest maker of agricultural machinery, Deere, reported quarterly sales that were below estimates. The company says that higher costs had an impact on farmers. Disruptions related to the invasion of Ukraine helped elevate prices of fuel and feedstock. That could lead to farmers to put off investments in machinery. And SpaceX reportedly paid $250,000 to settle an employee's claim that she was sexually harassed by Elon Musk. According to the online news site Insider, the rocket launch company made the payment to a flight attendant who worked as a contract employee on the SpaceX corporate jet. Musk, who's the founder and CEO of the company, calls the accusations utterly untrue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What we're seeing in the markets is a rotation from growth stocks with earnings very far in the future towards stocks that are much more value stocks, earnings here in the present. And this reflects the fact that real rates, for the first time in a very long time, are likely to go positive in 2023.
Great conversation with Ken Griffin of Citadel there, alongside Francine Lacquet yesterday here in New York City. From New York, good morning to you. Futures are positive by a little more than 1% on the S&P, on the NASDAQ 100 by 1.5. Yields traveling north, heading up higher by 3 basis points, 286.95, and the euro just a little bit negative, backing away from 106, Tom, 105.75.
It's going to be interesting. What do you think of Ken Griffin's comments, John? I didn't see them all, but I know you were studying it carefully. Did we learn anything?
He had something interesting to say about retail traders and Wall Street bets going after a certain hedge fund.
Yeah.
And how that wasn't nice because it was about going after teachers' pensions, which
lit up Twitter.
I have to say, I didn't really fully resonate with me, Tom.
It was so political. Thank you to Francine Lacquet for bringing up that third rail of sensitivity.
It's a great interview just to probe like that and just to get him to go deeper on it. I thought she did a brilliant job.
I'm going to stay out of it, as is Mr. Farrow, because we'd like to work Monday. Right now, and this is really important, the gentle lady from the Massachusetts Institute of Technology is with us, Katie Kaminsky is Chief Research Strategist of Alpha Simplex, and she and I are going to drag ourselves back in years to what mattered the last time commodities really lifted. Katie Kaminsky, you and I are not going to turn this into a nerd fest, but let's be honest. The reason the commodity game exists, as John Farrow mentioned, copper staggering a little bit here, is commodities trend like nothing else. Are commodities going to trend into 2023 where I could find alpha?
I would have to agree, yes. And let me give you a couple of pointers for this.
Please.
Inflation, first of all, is something that's very positive for commodity returns. Investors have forgotten about commodities because they haven't worked in a low inflation environment. Now let's take oil as an example. Oil prices have remained high despite some very, very negative things like a strong dollar, weakening demand in China, but yet we're still at pretty high oil prices. So what that tells me is there's still very much a commodity story that's left. And I think investors have forgotten about the value of commodities in a low inflation environment.
I'm going to go back to Tusha Shandy and a lot of the people that invented this and the whole CTA, Ballet, Monroe Trout, and all. Do you buy individual commodities as Farrow does? Folks, you should see Farrow on commercial break. He's over at the LME looking at aluminum and the whole thing. Do you buy individual commodities or do you buy a modern manufactured index or ETF?
Well, this is a good question because different commodities. Yeah, different commodities react differently to different environments. And so let's take last year or during COVID, we saw a very different move in energies than we saw in the precious metal basket. So certain commodities are more linked to inflation and then are affected by different supply and demand cycles. So thus, you should really think a little bit about what you're buying, what it's linked to, what type of cycles are going on in the markets, and which ones might be favorable given the current macro conditions. I'm always a big fan also of thinking about long and short. The reason for this is that over the long term, statistically, long and short indices and strategies and commodities have done better than long only, but I still suggest that you can add some long only exposure during certain cycles, which might actually help offset some of these really difficult moves we've seen in equities and bonds.
Well, Katie, that's exactly where I wanted to go, that we're talking about the move in commodities and betting on potential commodity producers and the like at a time when nothing else is working. Is commodities still the only bright spot, or do you see some of the other pockets starting to work again, like bonds?
Yes, the interesting thing about that connection, if you look back in the 70s, and I know it's a long time ago, it seems, but we had a very, okay, sorry about that. It's an interesting period to compare with because in that environment, we saw increased commodity prices. We saw bond and stock volatility being higher. Does that sound like what we've seen this month? And secondly, we saw positive correlation between stocks and bonds on occasion. Plus, we also saw commodities occasionally having different correlations with equities. And that is sounding like this month and this year. And so what that tells me is that there's going to be time-varying interesting opportunities. I just say that for now, I'd stay away from long bonds as you wait for rates to rise. But there could be some opportunities eventually as we see more yield. But commodities is still really the asset that's going to move the most with inflation and that has the highest potential to provide some offsetting return to what is a very challenging market environment.
Katie, what would you say to the Jonathan Gollops of the world who say that people have gotten way too bearish on stocks because, frankly, on a nominal basis, you get growth. On a nominal basis, you get revenues. On a nominal basis, a lot of these companies also provide an inflation hedge.
That's good as a point, but that's not a short-term view. I think the problem is we have to navigate the next few months. We need to navigate the rising rate environment. And so I think, even for bond investors, yeah, bonds give you a positive yield over time, but when yields are going up, it hurts. And so I think the point is he's right that you want to hold stocks over the long run, but you could also try and find ways to protect your portfolio in the short run as inflation and rising rates and growth destruction are a real challenge in a more uncertain environment.
Katie, thank you. As always, wonderful to hear from you. Katie Kaminsky there of Alpha Simplex. Lisa, I can find a lot of people who are bullish into year end. I can find very few who are bullish into the end of the summer. I can hardly find any.
Yeah, although if you look 6 months after that, they start to get a little more bullish, which raises an interesting question. What actually triggers that, right? What triggers that capitulation? Right now, there's so much pessimism based on this idea that the Fed is hiking into weakness, right? We talk about it with the ECB, but that essentially is what the Fed is committing to. How do they deal with it at a time when valuations still are stretched, at least in certain areas that people point to?
You know what the hope is? We get a few more months of inflation data. Hopefully it's convincing enough that we're on the right trend, with inflation coming in lower, and then we get to the end of summer and the Fed backs away, Tom. What backing away actually means I'm going to find interesting? Is it 25 basis point hikes? Is it a pause? What is backing away?
Again, it's non-linear, John. Let me get this calendar up here. I'm distracted by that wonderful trend-based discussion on commodities. Sorry, John. What are you looking for? Did you pay for my terminal this week?
It's paid for.
Okay, June 15th is a meeting. That's huge. And wrapped around the ECB meeting as well. Those are really non-analyzable. They're there, fine, whatever they do. I'm sorry, July 27, September 21, November 2nd, massively data dependent, massively non-linear effects.
September, Lisa, that's the one to look for, and I would say Jackson Hole ahead of that in August.
I was actually just talking about Jackson Hole last night with someone, talking about how they're going to position, given the fact that they're going to get that data, right? How can they say they're data dependent continually if the data is in and it shows a very decisive trend?
I think based on the data of the last 12 months, I don't think anyone can say this Fed's been data dependent. I don't know why we keep doing this. Go on, Tom.
The biggest problem that we've got is at the Pioneer Grill at Jackson Hole Lodge, they don't do a full English. They do a full Wyoming. It's a bigger breakfast.
Is it a better breakfast?
It's not better. It's
bigger.
A bigger breakfast.
Is it better?
It's full. I can see you there in a cowboy hat with the leathers on and the Tony Lama two-tones.
I don't know about the leathers.
Pioneer Grill, John Farrow.
I'll do my best to get there.
The risk right now is that when we look at equities so far, the derating that has happened was purely really a function of valuations.
Expensive companies were extremely expensive, and that's where all the pain has been.
Financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future.
This delicate balancing act is what the Fed's got to navigate, what all central bankers have to navigate.
We have to wait a little bit to see if what the Fed is doing is the right thing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday. An exhausting week, setting up for weekend reading, and then we will be in Davos, Switzerland next week. John Farrow, the tumults of the week, a better tape this morning.
This morning, but not on the week. 7 weeks of losses. That's what we're set for. On the session, up by about 1%. And the question I keep hearing asked repeatedly, have we seen the capitulation? Bank of America say this. Real capitulation is Fed capitulation. It's a systemic event. It's unemployment rising. That's what's required first, at least in the view of Michael Hartnett over at B of A.
The important reading for the weekend from Hartnett and John, what's so important there is that's linking in the economics with the market performance. But even looking at the market, John, we can't talk about capitulation with a VIX at 28.62. We're miles away.
And people waiting for something north of 30, Tom, approaching 40. Here's my thing, TK. This week, people were really spooked by those target numbers. Not because it was surprising, but because the market was so surprised by them. Just in terms of the reaction, to see a stock down close to 25% just like that, TK, off the back of a story we all thought we really understood and also thought was increasingly well priced. I think that was a shock for some people to find out that maybe it wasn't.
There are tea leaves out there, John, like Pakistan rupee, Turkish lira, and the rest. But the really underpinning here to the lack of capitulation is resilient dollar and somewhat of a quiescent bond market within the new bond volatility.
The biggest story, Tom, and I think it's going to resonate with people far outside Wall Street, we have a cost of living crisis around the world. Growth is heading in the wrong direction. Inflation is heading in the wrong direction. We haven't experienced that in the developed world for a long, long time. Not at this level, not as broad as this. And for the Europeans, I think that's the one to watch because they're right at the leading edge of all of this. Do they have to hike into a weaker economy? That's why for me at the next meeting, the ECB June 9th, there's a lot of pressure on President Lagarde to find the right path forward, and I'm not sure there is one.
And Lisa, I'm glad that John mentions this because I've been remiss on this today and frankly through the week as well. 9% is my statistic of the week. Maybe it's on the edge of double-digit inflation in the United Kingdom. Difficult German production inflation data today out of Germany. We're almost becoming used to it. We're rationalizing high inflation in America.
And 1970s continues to be the benchmark, not necessarily saying we're seeing a repeat of the 1970s, but today the UK consumer confidence read came out at the lowest levels going back to the 1970s just because of that dynamic that John and you are both talking about. How much do we see this paint a similar picture in the United States, right? Or how much is it a distinction that we see with momentum that people keep talking about that distinguishes the U.S. from other nations?
John, for the first time since time began, I'm almost on the same page with Klaus Schwab of Davos. I've been a critic of their themes and how far they are behind.
I've got to laugh through that, Tom. You're on the same page as Klaus.
No, I'm not on the same page as Klaus, but Dr. Schwab is saying history at a turning point. And for me, my phrase, my theme for this Davos is Davos and the end of the holiday from history. The holiday from history is so over. And John, this is underplayed this week because Ukraine is such a grind right now. This news in international relations folds into our markets.
Tom, I won't be at this event. I just wonder from your perspective, historically, you and I have been there a lot together. It's usually completely divorced from reality.
Yes.
You sense next week will be different.
I sense that about every 7 years, Davos is overtaken by the news flow. Why wouldn't that be this time around? All the certitude of belief is and all the mumbo jumbo, and it's just swept away by the news flow.
Looking forward to your coverage, Tom, through next week. Futures positive on the S&P by a little more than 1%. On the Nasdaq 100 up by 1.5%. Yields are high by about 3 basis points on a 10-year, 286.77. Bit of quiet out there. Some welcome quiet, some peace and quiet for now at least. Futures positive, Tom. Largely boosted a little bit, at least, by what happened with China. Chinese banks cutting rates.
Let's jump into it right now. The gentleman who knows the Cubs are behind the mark here in April and into May, and maybe we'll look forward not to Cubs baseball, but maybe what our Federal Reserve System will do. James Bianco is founder and president of Bianco Research. Jim, what are you going to write about this weekend?
About the economy, I think, in that there is a fundamental shift going on. It's probably the biggest story that no one talks about is this whole work from home phenomenon is something real, and it's something that's going to last. A recent study said that only 8% of the offices in Manhattan are back to full time. Everybody else is either work from home or hybrid. I think it was behind the target numbers too. They've got an inventory build on a lot of stuff people don't want, because when you've shifted your patterns of work and home, you shift your consumption basket. And I don't think we're ready to acknowledge that that's happening. And that's keeping the economy off sides, and that's keeping a friction in the economy and inflation higher than it would otherwise be.
So, Jim, what does that tell you about this week? Does that highlight the struggle the C-suite is having navigating this economy, one? Or two, does this signal a weakening of the economy? Because we traded on the latter, really, not so much on the former.
Yeah, we are trading on a weakening of the economy. And you've also seen it, say, in things like the Bank of America survey, where all of a sudden tightening monetary policy and global recession have surpassed inflation as the #1 tail risk for the first time in many months. And everybody is now worried about a global slowdown. I am too. But then they come to the conclusion that the Federal Reserve and other central banks are going to have to pause or pull back on their tightening after some round of initial tightening, say in the June meeting and maybe in the July meeting. And I don't see that. I see the central banks as being committed to trying to rein in inflation. And if you want to put it in market parlance, the Fed put is about unemployment and the inflation statistics. It's not about what level of the S&P do they change at. It's at what level does inflation have to come down to, or maybe unemployment have to rise. And I don't think a lot of people are, at least on Wall Street, ready to accept that as an answer. They think the Fed's going to stop because they're having a lot of pain. But a lot of people that have to live on a fixed income, that's who the Fed is focused on.
Jim, translate your view into a market call where a lot of people are saying buy the dip in bonds, and they're seeing a peak in yields exactly because of what you're saying, because they do believe that central banks will pause, that we will get inflation under control still, and that we can move along back to some sort of normal that we remember. What's your view on that?
You know, it's possible that we saw the high last week at 320 on the 10-year note, but I would probably bet not. What I think we're seeing now is a flight to quality. The stock market has been so volatile as of late that it's really trading, the bond and the stock market are trading as one. If you see a serious rebound in the stock market, you know, you're right, we're about to have the 7th up down week in a row. If we actually had 2 up weeks in a row, and you didn't see bonds make a run back at 320, then you'd have a chance of saying that we've seen the high. But I have a feeling that once the stock market finds its sea legs and then attempts a retracement rally, that yields are just going to go right back up again. So I understand the argument for 320, 10-year being the high of the year. I'm just not sold on it yet.
So where do you think we really see that capitulation? Can you elaborate a little bit more about the balance of buyers of some of these bonds and what people might not be understanding fully?
Well, there's been, at least in the statistics, not a whole lot of capitulation. You look at the future statistics or the surveys of managers, there's nothing there that suggests that we've ever gotten to an extreme short or underweight position to begin with. So it's been a year of real pain for fixed income managers. I suspect that they're still holding out hope that the slowness in the economy will get the Fed to stop, and that's why that they're trying to make the case for a turnaround and a rally in bonds. But I still think that the capitulation is to come. One other thing, whenever you've seen throughout the last 50 years, whenever you've seen yields go up this much, or total returns in the bond market, that's including price, fall this much, I always like to say that the bond market doesn't peak in yields until something changes. So it's usually bond yields go up a lot and something big happened, like a recession or like a financial crisis, or a serious slowdown in the economy at a minimum, and then that was the peak in yields. If last Tuesday was the high in yields, you'd say we had one of the biggest rises in yields or biggest declines in total return, and then some random Tuesday they peaked and that was the end of it. I'm not so sure that that's going to be the case this time.
Hey Jim, awesome to hear from you, buddy. Thank you. Jim Bianco there of Bianco Research. Some of this has been pretty random. Talked to a lot of people in fixed income about this. On any given day, you can have a move of 10, 15 basis points in either direction in the Treasury market, Tom, on any given day without much of a catalyst.
Well, yeah, look, I mentioned this earlier. I thought Michael Collins was just brilliant with PGIM. I think there's the verbal, John, of a bond bear market is radically different than the verbal of an equity bear market. And the magnitude of this drop in price, this is all new. I mean, people are making it up in bonds, not as they go, but literally hour by hour. It's
Tom,
serious.
To that point, and you can speak to this, we've seen a lot of corrections over the last few decades. We've seen a few bear markets along the way. How many people can say they experienced a bond bear market? Very few. Very few can actually say they've worked through that.
Back to the 70s. You do a log chart of the Bloomberg Total Return Index, pick the credit level, John, I don't care. And the answer is this is very 78, 79 and into Paul Volcker. I mean,
You said it. You said it.
it.
It's very 70s. Bramo
Late
Tibbetts, you said
70s is a difference.
Okay.
No, there's a difference. It was before K-pop.
I think, though, there is a larger point here about liquidity and the issue of just the incredible swings that you're seeing and the lack of conviction and where that stability comes from. This is supposed to be the deepest market, most liquid bond market in the world. What happened to that liquidity?
Mohammed Al-Erin has been saying the same thing repeatedly over the last few months. Futures are positive by about 1% on the S&P, and the Nasdaq up by 1.5%. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden arrived in South Korea and immediately underscored the importance of resolving the global semiconductor shortage. The president toured a Samsung chip factory that is the model for the company that plans to build in Texas. The White House says the Texas plant will mean good paying jobs and more resilience in the supply chain. More aid is on the way to Ukraine. A group of 7 finance ministers meeting in Germany are set to agree on more than $19 billion for Ukraine to guarantee the short-term finances of its government. That's according to Germany's finance minister. Meanwhile, the U.S. Senate has passed an aid package for Ukraine worth more than $40 billion and sent it to President Biden for his signature. And the administration said it was providing Ukraine with another $100 million in military assistance. Finland is becoming the 3rd European country to be cut off from Russian and natural gas. Like Poland and Bulgaria, Finland is refusing to pay for the fuel in rubles. The lost supplies will probably have a limited impact on the Finnish economy, though. Russian gas just accounts for about 5% of the country's energy mix. And in China, banks have taken a step aimed at boosting the ailing economy. They cut a key interest rate for long-term loans by a record amount. Lowering the 5-year loan prime rate would reduce mortgage costs, and it may help counter some weak loan demand caused by a property slump and, of course, those COVID lockdowns. And another roadblock for Boeing, which is trying to get airlines in China to resume flying the 737 MAX. China Eastern Airlines has outlined several actions it needs to take before operating the MAX again. Amongst them, more pilot training and modifications to the aircraft. Boeing says it continues to work with both airlines and regulators. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It is inflation. In the short term, it is inflation. In the long term, we need sustainable growth for all of our economies. We have to rehabilitate growth in a sustainable, inclusive way. It is for all G7 member states, all G7 countries, a key priority to fight inflation.
Good to catch up and hear from Christian Lindner, the German finance minister, a little bit earlier this morning. From New York City, good morning. Futures are positive on the S&P, Tom, by a little more than 1%. On the Nasdaq, up by 1.4%.
Very good. And again, the VIX under 30 nicely. 28.70 gives you some of the quiet that we're seeing in the market after this historic week. Right now, in an important conversation, and I'll go to John Farrow here in a moment, but I want to slip in one question with the United Kingdom's Secretary of State for Business, Energy, and Industrial Strategy. He, John, and the rest of the nation enjoying a 9% inflation. Kwasi Kwarteng is with us. He's celebrating Liverpool's European dominance and more than anything understands the gridlock of British politics. Author a decade ago of Gridlock Nation. What's the level of gridlock right now, Minister, in terms of dealing with 9% inflation?
Well, it's a huge challenge, Tom, and you will know that it's a global challenge. We had a pandemic, we had lockdowns right across the world. We had a huge surge in demand when those lockdowns were eased, and now we've got this unprecedented situation in Ukraine, first time in 70 years, 75 years, that we're seeing an actual war in Europe. So these are unprecedented times, and the British government has very much decided to help consumers, help people in the UK. We had a good announcement from the Chancellor in February about the kind of help that he was willing to give. And he and the Prime Minister have said that they are looking to help people more.
Let's talk about that and whether the consumer, the people of the UK are feeling that right now. Kwasi, you wrote a letter recently to petrol retailers about the concerns that the Chancellor's 5p fuel duty cut wasn't being passed on in any visible or meaningful way. What's the response been?
Well, we're looking at that still. I mean, I think it's very wrong of petrol, the forecourts, not to pass on the reduction. And I think, you know, we're seeing that there's some behaviour change, but there's a lot more they could do. And I'm very keen that they actually help out.
And yet you're against the windfall tax. Why is that?
I've been always against windfall tax. I think they're arbitrary. I think they discourage investment. And when you look at the companies that invest in the North Sea, you know, it's a very cyclical business. So when they make money, they tend to make a lot of money, and then when they lose, they make big losses, and they're not supported when they do make those losses.
You've talked about investment in the UK, and you're worried that it would deter investment. Bernard Looney of BP said to the Times earlier this month, he was asked basically whether he'd change any spending plans because of a windfall tax, and he said, quote, "There are none that we wouldn't do." Isn't that good news? That you can do this, that he won't change his spending plans. He's telling you.
Well, it's up to I mean, you can speak to Bernard directly yourself. I'm not quite sure what he was referring to, but there's no doubt that other players in the industry say that any kind of windfall tax would deter future investment. I mean, that's pretty obvious. And they need fiscal certainty. They don't want rabbits out of the hat, so to speak.
Well, BP's telling us the opposite. I just wanted to jump in with something the Chancellor said too. The Chancellor said, what I want to see is significant investment back into the UK economy to support jobs, to support energy security, and I want to see that soon. If that doesn't happen, then no options are off the table. Now, as you know, Kwasi, the prudent response from any Chancellor is not to take things off the table ahead of a budget.
Exactly right.
But I want your view on that. I want some goals. I want to understand what kind of investments you want to see from these players and over what time frame, because if we're going to wait for these guys, they've got a 10-year time horizon for their spending plans. We'll be out a decade and then we'll say, oh, okay, maybe we should do a windfall tax now. What's the time frame? How much spending do you want to see over what time?
We want to see spending. I'm not going to quantify it, but we want to see actual real spending. And there's evidence that they're doing that. I mean, if you look at our program from carbon capture, blue hydrogen production, both Shell and BP are directly involved in that in the northeast of our country, of England. And they can see that there is a huge opportunity in terms of green investment. And that's exactly what the Chancellor, the kind of investment the Chancellor wants to see. And as you say, the Chancellor's quite right to say all options are on the table. Every Chancellor I've known since I've been an MP has always said that. There's no way that he's going to take options off the table ahead of the budget.
Dr. Courtine, you enjoy a PhD in economic history from a small shop at the University of Cambridge. You know the history of this, and the simple history is windfall profit taxes do not work, period. It's well documented. But as John alludes to, there is a generational trust that has been broken between corporate elites and the people. How do you guarantee, given the lack of trust, a process here that helps the people of the United Kingdom?
So that's why the Chancellor was very clear, Tom, that they have to invest in the UK. We want to see their ambitions realised by their investment.
Do you need it in writing? Is it so urgent that it needs to be codified, to be in writing?
I think the commitments are already there. I'm not sure that we need any kind of legal document or quasi-legal document. But what they understand is that these new technologies, the decarbonisation, all of that stuff, needs investment, and it actually creates jobs. And you will also know that we're very interested, very focused on levelling up. That's actually giving opportunity to areas of our country in the UK, which in the last few years, few decades, have been underinvested. And so BP and Shell and others know that our commitment to levelling up and our commitment also to decarbonisation mean that business investment needs to happen, and they're very aware of that. And they also know, as the Chancellor said, that if they don't step up to that plate, then they could well be subject to a windfall tax.
Because
I think that's a reasonable conversation.
Just a final question, sir. Just on the final point. To understand what people are going through right now, if they listen to this conversation, you've got a company, BP, engaged in buybacks. I'm not here to say that's the wrong thing. They've referred to themselves as a cash machine when oil prices are climbing like they are. You've got the CEO who's saying he wouldn't change his spending plan if he faced the windfall tax. And we've got the government saying, we don't want to do that. You're saying that. Do you understand how deeply uncomfortable that might be for people who can't pay their energy bills this month?
Look, it's really difficult, but the investment actually helps people. People have pension plans. They want to have jobs. They want to have energy security. So I can't, as an energy minister, say, please invest in our energy security of supply, but by the way, I'm going to give you a windfall tax. That doesn't make sense. In order to protect energy supply, we need investment. And in order to have investment, we need a stable fiscal situation. We can't simply just threaten people with or have arbitrary windfall taxes. Having said all of that, as you know, the Chancellor of the Exchequer is responsible for the budget, and he's not taking any options off the table.
And he wouldn't be the first Chancellor to do it, as you know, because we could go back to the Conservative Chancellor of 1981, who did something similar. Kwasi, thank you. Great to catch up, and let's catch up soon. Thank you, sir. Kwasi Kwarteng, the UK, the Secretary of Energy and Business. TK, what a difficult moment for a lot of people.
It's not only a conversation in the United Kingdom. I think you're going to get a repeat of that, rinse and repeat here in America in months.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg. Live from New York City this morning. Good morning on TV and radio for our audience worldwide. We have a little bit of a pop, a bounce, a rally, whatever you want to call it. We're positive on the S&P, up by a little more than 1%. On the Nasdaq, up by 1.5%. Yields unchanged now on a 10-year, 283.70. Unchanged on the session, down on the week for a second straight week. Equities, unfortunately for many of you, down on the week as well for a 7th straight week. TK, it has been pretty ugly out there over the last 2 months.
Almost as ugly as in Liverpool. Right now, John Riding joining us here, Chief Economic Advisor at Green Capital. But on a Friday before the close of Premier League football, Lisa and I opened this up for full discussion with a gentleman of Preston North End and young Farrow as well. John Farrow, the only player I remember from my youth was Gerrard.
Oh, you love him, don't you?
I don't understand why I loved him, but I loved him. And I want you and Riding to talk right now about Sunday and for America, why Steve Gerrard really matters.
There's a great subplot to the story on Sunday. So on Sunday, you've got Manchester City top of the league of the Premier League. You've got Liverpool second. Manchester City win, it's all over. But Manchester City, John Riding, are playing Aston Villa, and Aston Villa are coached by Stevie G, the former great captain of Liverpool. That is a nice little subplot going into Sunday's games.
Yeah, and add to the fact that two of the key players for Aston Villa are former Liverpool players in Danny Ings and in Philippe Coutinho, who were rested against Wolverhampton against Burnley yesterday. And you've got a potential chance for those two. If they hold City, they'll deserve winners' medals from Liverpool.
That is a big game, Tom, not just for Manchester City and Liverpool, but for some of those people at Aston Villa as well. So lining things up on Sunday, Tom, I'll talk Eastern time, 11 Eastern, all the games all at once, the final games of the year, all played simultaneously. It is great to see.
Lisa, is there a soccer bar in Davos? I mean, is this what
I'm sure you'll find one, Tom.
Oh, the Bramo camcorder not paying attention.
Just leave me out of this one. I'm good. I wanted to talk about John Riding's experience
Lisa,
at the Atlanta Fed, and I wanted to actually
talk
about
Liverpool and Preston.
I know.
North
Well,
End.
fine, John, but I want to talk about the Fed. So bear with me.
Lisa.
Let me just take a quick move over there, and then you guys can all talk about football.
Thank you.
And I will let you go to the pub together on it. I am curious, though, especially after being at the Atlanta Fed confab just recently, there seems to be a belief in markets that the Fed is going to recognize the slowdown that we're seeing in some of the